The markets are closed, the ticker tape has stopped, and for the first time in days, the price of silver is not moving, frozen at $71.91, a stillness that most retail investors mistake for safety, believing the battle is paused and that they can relax through the holidays. But professionals understand that this silence is not peace. It is the calm before the most unstable and dangerous week of the entire trading year, a period on Wall Street known as Ghost Week, the 7 days between Christmas and New Year's when senior risk managers, hedge fund principals, and central bank veterans leave their desks and disappear to Aspen, St. Bart's, and private islands, leaving a multi-trillion-dollar financial system in the hands of algorithms and junior traders, creating a liquidity vacuum where in normal conditions it takes billions of dollars to move silver by $1. But during Ghost Week it can take only a few million. And this is why holding $71.91 into this period is both a technical victory and an extreme risk. Because we are hovering just below all-time highs, where the market is coiled like a compressed spring, storing massive energy with no human oversight to guide its release. And when futures reopen for the shortened holiday session, that energy must go somewhere. Yet the trading floors of J.P. Morgan and Goldman Sachs will be ghost towns, with maybe 3 junior employees sitting at desks designed for 50, operating under strict instructions to take no risks and make no decisions, which paradoxically makes the system more dangerous, because if unexpected news breaks, whether geopolitical conflict or a mining disruption, these junior traders do not have the authority to deploy capital to stabilize price action, meaning any large sell order is allowed to crash the market unchecked, and any large buy order is allowed to explode price upward, effectively removing the shock absorbers that normally smooth volatility, leaving price action vulnerable to flash crashes and melt-ups with no fundamental justification, while high-frequency trading algorithms remain active 24/7, indifferent to holidays and emotion, feeding on momentum, amplifying every move as price drops. Trigger shorting cascades and price rises, trigger chase buying, all without a human hand to say the price has gone too far, turning technical analysis into tissue paper as support and resistance levels are ripped apart by machines in an illiquid environment, while bid-ask spreads widen dramatically from pennies to dollars as market makers withdraw and demand massive premiums for taking risk, meaning traders lose money simply by entering and exiting positions, which is why Ghost Week is not a time to trade, not a time to use leverage, not a time to scalp because you are playing poker against machines that see your cards in a casino that takes a brutal cut, whereas long-term holders of physical silver are unaffected by screen volatility. Yet for paper traders, the experience is psychologically brutal. As price swings defy logic, headlines lie, and the market reveals a truth few want to accept, that when humans leave the room, the machines take control, and volatility becomes law, not exception. To truly understand what comes next, we must look beyond charts and into the physics of liquidity itself, because liquidity is the ice beneath the market. Thick ice allows trucks to drive across without consequence, but during Ghost Week that ice becomes dangerously thin, and even a small step can send you crashing through, which is why the order book matters more than any indicator. And if you visualize it as a ladder with buyers on one side at $71 and sellers on the other at $72, in a normal market, every rung is filled with thousands of orders allowing price to move smoothly. But during Ghost Week, the ladder is missing steps, jumping from $72 to $72.50 to $73 with no resistance in between, creating air pockets where price doesn't climb but teleports, producing chart gaps as even small orders behave like massive ones, amplifying movement in both directions, and with current momentum pointing upward, the path of least resistance is higher, reinforced by the statistical anomaly known as the Santa Claus Rally, where markets historically drift upward during the final trading days of the year and the first days of January, not due to magic but psychology, as short sellers close positions before the holidays and step away from their screens, removing selling pressure and leaving only buyers and passive inflows, allowing price to float higher like an untethered balloon, quietly breaking major resistance without headlines, Yet this bullish drift exists alongside extreme fragility, where fat finger errors or predatory algorithms can trigger flash crashes that hunt stop-loss orders and wipe out leveraged traders in seconds before rebounding minutes later, making Ghost Week survivable only for those who avoid trading altogether, especially in paper markets, while physical holders remain insulated from screen noise, and this fragility is confirmed by the physical market itself, where bullion dealers technically remain open on Christmas Day, but hide behind soaring premiums, pricing Silver Eagles near $90 to protect themselves from potential gap-ups, signaling real scarcity because, in normal markets, dealers compete on price, while in shortages they raise prices to avoid selling, proving that the true price of silver is not $71.91, but whatever must be paid to obtain it. And as Ghost Week fades, the real force arrives in January, when the financial system resets and trillions of dollars of institutional capital are deployed through mandated rebalancing, as pension funds and asset managers confront the failure of stocks and bonds in 2025, while silver emerges as the top-performing asset, creating career risk for managers who failed to own it, forcing massive buying not as speculation but obligation. And when billions attempt to enter a market whose annual supply is only worth $25 billion, price must rise to ration demand, turning $100, $200, or even $300 silver from fantasy into mathematics, driven by the collapse of the traditional 60-40 portfolio and the institutional search for non-correlated assets, making silver a permanent strategic allocation rather than a trade, creating a persistent bid, month after month, year after year, lifting the price floor continuously. And when January volume returns as bank desks reopen and full liquidity collides with physical shortages, the result is the most bullish signal in markets,